This content is for informational and educational purposes only. It is not financial advice, investment advice, or a recommendation to buy or sell any securities. Always do your own research and consult with a licensed financial advisor before making any investment decisions. The views expressed are my own and based on current market conditions, which can change rapidly. Let's talk about the biggest tech giants in the market, famously known as the Magnificent Seven: Apple, Amazon, Microsoft, Meta, Alphabet, Tesla, and NVIDIA. These tech titans are crashing harder than the rest of the market. So why are these top tech names selling off, and why are foreign investors suddenly pulling back from the US? What does all of this mean for your portfolio in 2025? Stick around, because the answers might just shock you. It's been a brutal stretch for these former market darlings. The Magnificent Seven, those iconic tech titans that once carried the entire market, are now the biggest source of selling pressure. These 7 stocks alone made up over 60% of the total notional selling. That's dragged their net exposure to a level we haven't seen in nearly 2 years. Notional selling refers to the total dollar value of the stocks being sold, not the number of shares, but the value of all those trades added up. So when we say there was a lot of notional selling, we mean a huge amount of money was taken out of those stocks. And the numbers tell the story. Year to date, the S&P 500 is down just over 10%, but the Magnificent Seven, down nearly 22%. Strip them out, and the remaining 493 stocks are off by just 5%. It's not just a tech correction, it's a complete reversal in leadership. For the first time in years, all 7 of these stocks are doing worse than the rest of the market. That's a sharp turnaround from 2024, when they were leading everything. Their valuations have dropped quickly. At the end of last year, they were priced at 32 times their expected earnings. Now that number has fallen to 22. In comparison, the rest of the S&P 500 has only gone from 22 to 18. Let me put that in simple words. That means investors were once willing to pay $32 for every $1 these companies were expected to earn. Now they're only willing to pay $22 for the same profit. In comparison, the rest of the S&P 500 has only dropped from 22 to 18. These stocks are losing their edge, and they're losing it fast. The crowding is becoming a liability. Everyone ran into the same names, and now they're trying to get out. Gold has been the standout performer, beating the S&P by over 30% this year with a $14 billion inflow into the top 3 ETFs alone. What's driving this? Some are pointing to AI. The spending race in artificial intelligence, hardware, software, infrastructure, it's been burning a hole through balance sheets and investor expectations. Every stock in the group is getting hit. It's not just 1 or 2 struggling, they're all feeling the pressure. The drop in value isn't random anymore. It's happening across the board all at once. There's a bigger picture here too. These companies were seen as symbols of America's strength, and investors from around the world rushed to buy them. That helped push up the value of the US dollar. But now that investors are pulling out, we're starting to see the cracks, not just in the stock prices, but in the dollar as well. In fact, the drop in these 7 big stocks might be hurting the dollar more than interest rate changes ever did. Still, it's not all bad news. The Magnificent Seven are expected to grow their profits by almost 15% this quarter compared to last year. If you take them out, the rest of the S&P 500 is only expected to grow around 5%. So yes, their stock prices might look rough right now, but their actual business performance hasn't crashed, at least not yet. Looking ahead, investors are already starting to think about 2026, even though it's still 8 months away. And while these big names have been falling, the rest of the market, the other 493 companies, is slowly catching up. The gap between the leaders and the rest is getting smaller. Then there's NVIDIA. On paper, it looks like a bargain based on its future earnings. But that can be misleading. It's risky to buy a stock just because it looks cheap when profits are at their peak. Sometimes what looks like a deal is actually a trap, because the high earnings may not last. If you found this breakdown helpful, make sure to hit that like button, subscribe, and turn on the bell so you don't miss the next deep dive. The markets are moving fast, and I'm here to help you stay one step ahead. Drop your thoughts in the comments. What's your take on the Magnificent Seven? I'd love to hear it.